Then I think we can start. So good evening, everyone, or good afternoon if you're further west, sorry. So it's my pleasure to welcome you to this new edition of our e-Axis webinar series, the last of 2021. First, I would like to thank you warmly for participating to most of our webinar this year. I hope you enjoyed them as much as I did. I think that we had a very nice selection of academic research and policy paper around climate finance and monetary policy this year, and that they addressed very much a key issue in the debate surrounding policy making in this domain. Today, we will look at another major issue, climate risk and financial stability, and Parisi will present ECB's latest analysis on this topic. Before doing that, let me just remind you that we have a Slack channel associated with this webinar, where you can exchange literature, information, and also ask questions if you have some. I would also announce that our webinars series next year will follow a slightly different structure. We will keep the focus on one specific issue for a series of 3 seminars. One seminar with an academic paper, one with research by practitioner, and probably a policy debate in the last webinar. All these 3 linked by one issue, one topic. And the first 2 issues that we will have a closer look at the following. They're not settled yet, so we're happy for your inputs. We would like to look at what are the question of whether environmental externalities are priced by financial markets or not. And maybe a second question on which allocation benchmark should policymakers follow with their monetary policy implementation. So if you have other issues that you want to address, please feel free to write in the Slack channel. Also, if you want to suggest papers on the questions that I just highlighted, or suggest discussions for that, happy to have them in Slack. That being said, and without further ado, let me introduce you to Laura Parisi. Laura is a team lead in the newly established Climate Change Center of the European Central Bank that operates under the supervision of President Lagarde. Laura's primary research focuses on the impact assessment of climate-related risk for the banking sector and for the overall economy. She leads the ECB team working on climate stress testing, and she also collaborates with European and international institutions. She previously worked in the stress testing modeling and the financial regulation and policy division in the Directorate General Macroprudential Policy and Financial Stability, and she holds a PhD from the University of Padua. So today, Laura is going to walk us through the results of the economy-wide stress test that the ECB recently completed. But before giving you the floor, Laura, I would like to ask for our two usual questions before the seminars. You can all answer them. The first one is, how severe and spread are climate risk in the European banking sector? Insignificant for all bank, low, moderate, high, with most not exposed. I'll let you choose your assessment. And the second is, which climate risk channel is the most relevant for the European banking sector? So climate hazard in some region, climate hazard at the macroeconomic level, transition risk in the sector or region, or transition risk at the macroeconomic level. Let you answer this question, and I guess that will inform you about who are our audience before talking. Maybe you can have the answers. Alors, climate risk are moderate with some banks very exposed. We'll see if that matches your assessment. And below, what are the most relevant transmission channel is transition risk exposure with some economic sectors, and after that, climate hazard in some regions. So here
it's very interesting.
So I don't know if you want to comment directly on that, but I guess after your presentation, we will have we will see if that matches what you at the ECB have found about weaknesses and maybe strengths of the European banking sector regarding climate risk. Laura, the floor is yours.
Indeed, I think we will go through these questions, let's say, in some of the slides during the presentation. So hopefully we can, at least based on our methodology, give some answers. I don't know, Pierre, shall I share my screen then with the presentation?
Yes, if you could share your screen, and also just for you to feel free to ask questions in the Q&A section. I will relay them to Laura after the presentation.
Can you confirm you can see the slides in full screen?
Yes, we can. Thank you.
Perfect. Thank you very much, and indeed good morning or good evening, depending on where you're located. And thank you very much. I would like to thank Pierre for his invitation and for the opportunity, let's say, to be here with you and to present this piece of work. What I'm going to show you is indeed, let's say, the main features and results of the ECB economy-wide climate stress test that we published just a couple of months ago. And so in case indeed you're interested in a lot of methodological or technical details beyond what I'm presenting you, you can refer to the occasional paper that was published in September. I would like to start, let's say, this overview with you, giving you a bit of spoiling, let's say, a little bit what is coming in the next slides. And in particular, I would like to present you three main features and four key results that we will see later on, but at least to set a little bit the ground and make you understand what it is that we are talking about here. So first of all, starting with the features on the left-hand side of this slide, let me remark that this ECB economy-wide climate stress test is slightly different from similar exercises that were conducted by other central banks. And the reason why it is different lies, for example, or let's say mainly, in the fact that it is a top-down exercise. What I mean here is that differently from, for example, the Banque de France or the ongoing Bank of England stress tests, this exercise does not rely on banks' submissions, so on banks' self-assessment of climate risks on their own portfolios, but it's an exercise that has been centralized and so conducted exclusively internally by ECB staff relying on our data and models. So in order to make it possible, let's say in order to deliver and to perform a top-down exercise, there are three key features that have to be developed. First of all, we had to develop climate scenarios, and in particular, and once again, setting a bit of a difference with respect to other exercises, we wanted climate scenarios that account for the interplay and the interdependencies between transition and physical risk over the next 30 years. We will see a little bit more in details what I mean here with interplay between transition and physical risk. So technically speaking, we relied on the work conducted by the NGFS, but we had to apply, let's say, a few adjustments here in order to make these scenarios usable in practice. The second important element is that in order to assess all these impact at a very granular level, we had to collect climate and financial information for all the banks located in the euro area and all their exposures to non-financial corporates. So this meant that we had to collect millions of financial and climate information for all the NFCs, the non-financial corporates to which euro area banks are exposed to via loans and security holdings. So to the best of our knowledge, this represents the most comprehensive and the huge, let's say, data collection about climate and financial information available in a central bank or more broadly in an institution as far as we know. The third and last feature is the development of new models to capture the very specific nature of climate risk and their transmission channels on firm financials via credit and market risk channels. And we will see also why, because when we talk about climate risk, we talk about specific risk drivers that are not captured in traditional credit and market risk models. Moving to the results. Well, first of all, you have to understand that what we are taking here is a public institution perspective. So one of the key questions we had in mind was to understand what are the trade-offs between the cost of a transition and the cost of a no transition. And the first result indeed shed some light on this and clearly showing that the short-term costs of transitioning towards a greener economy are always more than compensated by the long-term benefits that such a transition could imply. Secondly, we find that in case policies to transition towards a green economy are not introduced, well, then physical risks become increasingly higher over time. And such increase is also nonlinear. So if you combine this nonlinearity feature together with the reversible nature of climate change, if unfettered, you understand that such increase would continue over time and would actually explode after some trigger points. The third result is related to the magnitude, let's say, of the impact that we find being on average quite moderate until 2050. However, we also find that this impact is very much concentrated in some geographical areas and economic sectors. And when we talk about the financial stability implications, these concentration risks or these tail risks are of particular relevance and have to be monitored. Finally, if we focus on the corporates and the banks that are most at risk, we find that on them the impact is potentially very severe with indeed consequences for financial stability. So in the rest, let's say, of the presentation, I will go through these three main features, explaining them a little bit more in details, and then I will move to the results. So starting with the first, let's say, feature here that is the climate scenarios. So we, as I said before, we wanted to account for the interplay between transition and physical risk using a time horizon of 30 years and leveraging on the NGFS scenarios. Just as a matter of clarity here, we used the NGFS scenarios released in July 2020. We had no time to update all the analysis with the scenarios that were released just this July in 2021. However, this is work ongoing. But this is important to keep in mind because like the caveats that you will see here have been partially solved in the new release. And I think this is like, as a matter of transparency, is important to consider. So in particular, looking at the first release of the scenarios, we found two problems, let's say, at least related to our application. First, the transition and physical risk impacts on GDP were modeled separately and were also provided separately in terms of output. In order to overcome this issue, we built a matrix of three scenarios that combine these two separate impacts in one, let's say, impact on GDP. The second issue was the level of aggregation. So the GDP impact from both transition and physical risk was aggregated in 11 macro regions worldwide. And just to give you an idea, Europe was one macro region. So you can imagine that from our perspective, in which like we wanted to have a very granular exercise, this level of aggregation was definitely not enough. So what we did was to use all the granular data sets that we collected in order to disentangle the projected CO2 emissions and the damages from physical risk in the different scenarios at the different firm level, indeed to have this sort of more granular approach. So starting with the matrix, let's say, of the three scenarios. This is represented in the chart on the left-hand side of this slide. And in terms of narrative, we derived three main climate scenarios. The first one is the so-called orderly transition scenario that from a climate, let's say, perspective, represents a temperature increase of 1.5 degrees globally by the end of the century with respect to pre-industrial levels. So this scenario is fully in line with the Paris targets. And from a policy perspective, this implies an early, orderly, and effective implementation of climate policies to reduce CO2 emissions and thus to limit the temperature increase. From an economic perspective, this implies transition costs that, however, remain relatively limited because indeed the transition is effective and implemented, let's say, in an orderly and early way. And on the other hand, from the damages, let's say, coming from a physical risk also remain quite limited because these policies indeed manage to limit the CO2 emissions and the overall effects of climate change. The second scenario is a disorderly transition scenario that indeed, going to the climate perspective, implies a temperature increase of 2 degrees by the end of the century. In economic terms, this means, let's say in policy terms, let's say, sorry, starting from there, this means that policies to transition towards a green economy are implemented, however, in a delayed manner. So you can imagine that until 2029, we do nothing. We leave, let's say, things as they are, and then in 2029 or 2030, we suddenly realize that we have to implement these policies in order to meet the Paris targets, and these policies have to be quite abrupt in order, indeed, to meet the targets. So, from an economic perspective, this is translated into having transition costs that are higher than in an orderly transition scenario because of the delayed and abrupt, let's say, nature of such policies. And from a physical risk perspective, this also means having higher costs coming from increased physical risk because of the delay of the implementation. If we do nothing for 10 years, then we can expect additional physical risk to build up in the system until CO2 emissions are reduced. The third scenario that is the most severe is the hot house rule scenario. In this case, we assume that no additional policies on top of current ones are introduced to limit CO2 emissions and mitigate climate change. And this means that we have no costs or very limited costs from the transition, because indeed there is no transition at all. However, there is a lot of creation of physical risk in the system, exactly because of the same reason, which translates into higher costs that have an impact on GDP. So in these last scenarios, from a climate perspective, you can easily understand that there is no, let's say, the Paris targets are definitely not met. So there is no compliance with the Paris targets. Also, to explain a little bit how the results will look like, we take the orderly transition as a reference scenario. So in most cases, you will see the results in these two adverse scenarios, number 2 and number 3, derived with respect to the orderly transition. Having a look now at the numbers, this is what we found. And as I said, this relies mostly on the NGFS scenarios with the true adjustments that I mentioned to you at the very beginning. So these scenarios here are projected until the end of the century, but our stress test focuses on the first 30 years until 2050. And the chart on the left-hand side is showing you what is the GDP evolution indexed with respect to 2005. And I want to show you these numbers because for those of you who may be familiar with other stress tests, like, for example, the EU-wide stress test, well, you can see that this is very different from what is typically considered in an exercise of this kind. And it is different because here we are dealing with scenarios in which GDP is projected to increase no matter what. So, and this is important to keep in mind, as I said, because it explains also a little bit the results that we will see later on. We have a scenario, we have even adverse scenarios with increasing GDP. The difference being different, let's say, rates of increase in the adverse scenarios with respect to the orderly transition. And this can be displayed, is shown in the chart on the right-hand side, where you see indeed the GDP deviation from the orderly transition that is our reference scenario. So what you can see here is that, first of all, the orderly transition is always the first best option, while the hottest world is the worst case scenarios, especially in the long run. You can also see that the orderly transition has very limited advantages with respect to policy inaction, and it's limited in magnitude and also in time. So even, like, let's say, when looking at the impact of climate risks on GDP, even already here, you can see that the costs of the transition are compensated from reduced damages from physical risk in the medium to long run. Moving to the second feature of our exercise, that is the data, the collection, let's say, of this information. Indeed, we built a very comprehensive data set that assesses or that brings together very granular information on financial and climate risks for millions of corporates to which euro area banks are exposed. So we started with the physical risk score, which measures the probability, so the frequency and the magnitude of future natural disasters for every single address in the world. These data were collected from 427, which is an affiliate of Moody's, and we collected this information for 4.3 million companies worldwide that we were able to geolocate, as I said, at the address level. The advantage of this data set is also that provides this information separate, so in aggregate, but also separately for different physical hazards. And we will see that in one slide. We also then collected information on transition risk, which basically means greenhouse gas emissions for 5 million companies worldwide that we were able to associate with the 4-digit NACE level information. And we collected not only the historical greenhouse gas emissions, but we also estimated the projected greenhouse gas emissions based on the NGFS scenarios and based on companies' emission reduction targets were available. So this gave us, let's say, a comprehensive, complete picture of what are the vulnerabilities of these companies to transition and physical risks. But since we are talking about a climate stress test, which is also a financial exercise, we had to combine this information with financial information on the main balance sheet items of such companies. And we relied on internal data sources for that are coming from commercial data providers. And here I listed Orbis, Icon, Bloomberg, and IBA. So the first 3 blocks are indeed assessing these vulnerabilities for the corporate sector. And this is giving us indeed the corporate perspective. But we then wanted to transmit this information or these vulnerabilities to the banking sector. So to do that, we had to match this with banks' exposures. And for this last block, we relied on regulatory information that are quite sensitive and available only internally, and they are Anacredit and SHS. So Anacredit is a new data set available in the euro area that provides loan by loan exposures of euro area banks to European counterparts. So there are approximately 4.2 million companies listed in such a data set. And together with that, we also looked at banks' exposures to non-financial corporates via security holdings. And this is also a regulatory data set that is called SHS. So overall, after we brought all this information together, we ended up with 2 samples, one of firms and one of banks. So the first sample includes 2.3 million companies in Europe. And overall, this represents 80% of the entire exposures in Anacredit. So we have a very good, let's say, level of coverage. And the bank sample includes 1,600 consolidated banking groups in the euro area. So basically, we managed to cover the entire world of financial institutions, of monetary financial institutions in the euro area. We, of course, had some problems, let's say, to solve while bringing together all this information, and wherever, let's say, we tried to fill these data gaps as much as we could based on proxies calculated on the available information. So this is a snapshot of these data sets or of this climate data that I just mentioned. On the left-hand side, you have transition vulnerabilities, and on the right-hand side, you have the physical ones. So on the left-hand side, you can see the emissions or the emission intensity by country sector, where you have the country here on the y-axis and the sector here on the x-axis, expressed in tons of CO2 equivalent. And this chart, we limited, sorry, this chart to the euro area, let's say, countries for simplicity. And what we could observe out of this chart is that actually there are no big differences across euro area countries when it comes to CO2 emissions. The differences instead are mostly rely on sectoral differences. So there are a few sectors that are emitting, let's say, significantly more than others across euro area countries, and these, in line with intuition, are mining, electricity, and manufacturing. When instead you look at the chart on the right-hand side, well, this chart is showing you the vulnerability of each non-financial corporate that we were able to geolocate at the address level to future physical risk, distinguishing between different risk hazards. So here you can see in blue a vulnerability to floods, in yellow to other hazards, in light blue to sea level rise, and in red to wildfire. And in green, we basically flagged all those NFCs that are relatively at low risk across hazards. So what you can see or observe out of this chart is that instead, when it comes to vulnerability to physical risk, the geographical component is extremely important. And physical risk hazards are very heterogeneous across countries. In particular, we found that South European countries or south areas are more subject to the risk of wildfires and relatedly to heat stress, while Middle and North European countries are more subject to flood risk. And this is the non-financial corporate perspective. When we move to the banking perspective, well, here we basically looked at banks' exposures to transition and physical risk, clustering their counterparts in low, medium, and high emitters on the left-hand side, and low, medium, and high physical risk on the right-hand side. So the chart on the left-hand side is basically showing you what are banks' exposures to low, medium, and high emitting companies across countries or across banking systems. What we observe is in line with what we saw before. So we don't observe a strong cross-country differences, at least here in the euro area, because more or less all banking systems have an equal share of exposures to high and medium polluting firms. Just France and Italy have an exposures to high emitters that is slightly above average, but as said, more or less everyone is floating around the euro area average. When instead you look at the chart on the right-hand side that is showing the banks' exposures to physical risk, well, here the situation is very different and also reflects the map we saw before. Because here you can see that there are some countries, especially located in South Europe, that have very high exposures to high physical risk companies. So to companies that are subject to high physical risk. And these are Greece, Cyprus, Portugal, Spain, and Malta to a less extent, while other countries instead have numbers that are much below, let's say, the euro area average. So here we can see indeed a sort of clusterization across geographical areas that instead is not the case when it comes to transition risk. Still talking about the data and the data sets and indeed banks' exposures to this kind of risk. Since we also had a financial, let's say, stability perspective in mind, we looked at tail risks. So we, for example, on the left-hand side, focused on the banks that have the highest exposures to polluting firms. And what we observed is that approximately 150 banks, that in our sample is less than 10% of banks in number, account for 30% of the total exposures. So it's relatively big banks, or bigger than average banks. And they account also for 60% of the entire emissions in the euro area. So you can focus here on 10% banks being exposed to 60% of the overall emissions in the euro area. If you want to go even deeper, what we observed is that out of these 150 banks, and in particular 65 banks, that in our sample is less than 4%, account for 20% of total exposures and almost half of the overall emissions. So we already, let's say, started observing at this stage the risk of concentration in some banks that are, let's say, subsidizing or funding most of the high polluting companies in the euro area. We also tried to look where these banks are located, and we found that they are mostly coming from Italy, Germany, and France. On the left-hand side, we did a similar exercise, but focused on physical risk. And even here, trying also to distinguish between different hazards, we found that 22% of total banks exposures are actually subject to high physical risk, and most of them are driven by wildfire that you see in red here. When it comes to where these banks are located, well, these are mostly concentrated in Spain, Italy, and Greece, which is quite interesting to observe because indeed we are talking about South European countries, once again in line with what we observed before. The third, let's say, important element of the exercise that I mentioned at the very beginning is the methodology, because indeed we had to build new models, completely new models, to assess, let's say, the transmission channels of climate risks to the non-financial corporate sector and the banking sector. And this also explains a little bit the economy-wide nature of the exercise, as we also assess these impacts on the entire, let's say, non-financial corporate sector. So starting from the risk drivers, we considered both transition and physical risk. The transition risk drivers that we assessed are carbon costs, that can indeed be impacted by potential policies that are introduced to transition towards a greener economy, and that in turn can have an impact on firms' revenues. The second channel is the technological change and energy efficiency. So technological change here means that firms do have invested in changing their production process if they want to be compliant with a greener economy. And this in turn can translate into changes, let's say, or an impact in their operating costs and their level of debt. But also energy efficiency as a result of such a technological change actually can bring some impact, in this case in the form of a benefit, once again on the operating costs of the company. The third element that we considered is changes in the demand for goods depending on their carbon footprint, that once again, like the demand can also impact firms' revenues. On the physical risk side, we accounted for the direct damages coming to physical capital due to natural catastrophes driven by climate change. And on the other hand, we also accounted for the potential disruption in the production process, once again caused by natural disasters. All these, both these effects do have also an impact on firms' revenues, costs, and debt levels. So the revenues, costs, and debt levels that are assessed this way, in turn, do have an impact on firms' profitability and leverage that also feed into the probability of default of these companies, together with the aggregate macroeconomic conditions. When coming to climate change, there are also two other important factors to consider, which are mitigants and amplifiers that are also very specific of climate risk. We did account for them, although partially, so this is also, let's say, work or homework to do for the next steps to increase a little bit the coverage here. In particular, as a mitigant factor, we accounted for the insurance coverage that protect a physical capital from damages. But on the other hand, we also, as an amplifier, accounted for potential increases in the insurance costs, especially for those companies that are subject to increased natural disasters over the next years in the different scenarios. So all this impact on corporates are then transmitted to banks via credit and market risk in two ways. To account for the credit risk, we calculated the aggregate default probability of credit portfolios of the banks that we have in the sample. And secondly, we also calculated the losses from corporate bond repricing. So this is what we will see for banks. And going to the results, I will show you first the results for corporates and then the results for banks. So starting from the corporate sector, indeed, I tried to also summarize them here in the slide at the very beginning, and in particular, showing that the short-term costs of a transition are always more than compensated by the long-term benefits, and also that the transition is more costly for carbon-intensive firms. However, physical risks do increase, especially in a no-transition scenario, and they do so non-linearly. So moving to the charts, here I'm showing the default probability in the two adverse scenarios compared to the orderly transition for three different sets of companies: low-risk firms, carbon-intensive firms, and high physical risk firms. So starting with the low-risk firms, which are firms that do have relatively low vulnerabilities to both transition and physical risk, what we observe is that no policy action scenario, that is the red line here, as well as a disorderly transition scenario, do have some benefits with respect to an orderly transition in the short term. So this means that an orderly transition implies some costs that are also reflected in a slightly higher default probability in that scenario compared to these two. However, these, let's say, costs of an orderly transition are limited in magnitude. As you can see, like we barely go below the zero y-axis here, but and also are limited in time, as we expect, let's say, the situation to reverse between 2026 and 2028. In the long run, what we observe are benefits of the orderly transition compared to the other two adverse scenarios in which instead default probabilities are higher. If we look at the same chart, but for carbon-intensive firms, what this chart is showing us is that the transition is for these companies more costly than for low-risk companies. And this is also what we expected. So for firms that are currently very high emitting, well, changing, let's say, these their production process and shifting towards green investments and green process and green production implies some costs that are also reflected in a higher PDs. However, we also observe that the transition for these companies is even more costly if delayed. So even in this case, we see advantages of transitioning early rather than later. And in the long run, however, physical risk, let's say, dominates, although here just in the last, let's say, part of the horizon. And finally, if we look at the firms that are subject to high physical risk, here instead, the short-term costs of a transition are extremely negligible in comparative terms, as what dominates are the massive long-term benefits compared to a no policy action scenario. So for these companies, in case we have no policies to transition towards a green economy, the default probabilities can increase by up to 25% with respect to an orderly transition scenario. We then move to the results for the banking sector that mimic, I would say, mostly what we saw before for companies. And here on the left-hand side, you can see the aggregate default probability of banks' credit portfolios in median terms. And once again, here you can compare the short-term costs of a transition that is translated into an increase in the PD in the orderly scenario compared to the two adverse ones, to the long-term benefits of such an orderly transition in the long run. On the right-hand side, you can see also what could be, let's say, some indications of heterogeneities within the euro area. So the chart here in the middle is expressing for the euro area average what are the increases in PDs in 2050 compared to the orderly transition in the disorderly and hot outburst scenario. And this is basically what you see represented here at the end point. However, this is to be compared with the box plot at the very right of the slide that instead shows the dispersion across two euro area countries in these PDs. And this chart is basically showing us that when it comes to the disorderly transition scenario, the effects are quite homogeneous across countries, and the distribution here is rather concentrated around the median, the euro area average. However, when it comes to physical risk, this is not very much the case. So the impact, let's say, of a hothouse world scenario are very much heterogeneous across countries, and you have some outlier countries here in which such impact is actually up to 1.5 times higher than the euro area average. So this is pointing once again towards the result that we saw at the very beginning, that indeed, let's say, displays quite some clusterization in terms of physical risk impact. And the last result here when it comes to banks' credit portfolios is shown in the chart here on the left-hand side, where instead of looking at the evolution of default probabilities with respect to the orderly transition, we look at such evolution in the three scenarios compared to the starting point, so index, let's say, basically, with respect to 2020. Once again, for two samples of banks, the average banks that are represented here with the dashed lines, and the tail risk banks that are instead represented here with the fill line. So what we found is also, let's say, is explaining what I was telling you at the very beginning, because if you look at the median results, you can see that the impact of climate risk are relatively limited, or let's say increase moderately over the time horizon. And if you look at the orderly transition, actually you could see that an orderly transition even brings benefits with respect to current default probabilities. But if you instead focus or look at tail banks, well, such impact can be much more severe. And in case policies are not implemented, such increase in default probabilities can go up to 30%. So also, once again, to reflect a little bit on these tail banks and how vulnerable they could be, we once again observed that approximately 10% of the banks in our sample that accounts for 20% of overall exposures are 5 times more vulnerable than other banks in the same hothouse world scenario. So this is one of the reasons why we are particularly, let's say, focused on climate risk for financial stability reasons, exactly to look at these tail banks that can be potentially quite vulnerable. As I mentioned at the very beginning, we didn't stop here, because we also looked at changes in LGDs and in expected losses. So we, together with the changes or evolution in banks' default probabilities, we also looked at 2 channels via which LGDs, loss given defaults, let's say, could be impacted by climate risk. One is the macro channel that captures the sensitivity of this variable to macroeconomic condition. And the second one is a micro channel that instead captures a depreciation of physical collateral coming from natural hazards driven by climate change. So here in the chart on the left-hand side, you can see the distribution of the increase in these LGDs between 2050 and 2020 in the three scenarios. And even for LGDs, you can see that the impact is increasingly higher going from the orderly to the hot as well scenario. So that's confirming basically the ranking of scenarios that we mentioned at the very beginning of this presentation. And here on the right-hand side, we wanted to give you a bit of an idea or a hint of what we mean by physical collateral and how much this accounts, let's say, in our calculation. So in particular, this chart is showing you how much collateral is covering, let's say, for loans in the different banking sectors as mapped in Anacredit. And out of this, how much is represented by physical and non-physical collateral. So the physical collateral is the part, is the blue bar, let's say, in this chart. And this is exactly the part that we stress because of depreciation coming from natural hazards. So the depreciation, let's say, in this section of the physical collateral that we were able to geolocate the adverse level, by the way, and this is why we could map each of these collateral location with the vulnerability to physical risk, is the one that is indeed impacting, let's say, impacting this distribution of LGDs. And bringing all these two together, we also calculated the average expected losses, which means how much, let's say, expected losses could occur in the different scenarios compared to the orderly transition, and also how much these distributions change across jurisdictions. Once again, confirming that, especially in the hot as well scenario, we have some countries that are out of scale with respect to the euro area average. I will conclude here because I see also Pierre here on the screen. So this is really the very last slide, and happy to take questions later on. Just to summarize indeed a little bit the results, we observed clear benefits of an orderly transition to address climate risks, and especially the absence or delay of policy action can imply significant risks for financial stability. So although, let's say, this exercise has been, in our view, a big step forward to understand these risks, we are also very much aware of the limitations. And in particular, some gaps remain on data and on exposures and on asset classes that we have not considered in this exercise. So for sure, we have to work on this and expand the analysis. And in parallel, we are also working very closely to improve disclosure standards. The work will not stop here, so we are already at work for the next steps to update our methodology and to apply this methodology to other ongoing climate exercises at the ECB. But as I said, I will stop here and happy to continue the discussions via the Q&A.
Thank you very much, Laura. I have to conceal that that I had an internet problem during your presentation, so I missed about 5 minutes of it. And in the process, I also lost a few questions in the Q&A session. So if everybody can retype the question that they had, so I can get them back. But I noted down two quick questions on the methodology and on the methods. They are a bit technical, that need a bit more explanation for people. One of the questions was regarding the geolocalization of firms. Is that the headquarters of firms, or is it the producing facilities? And then there was also another question on how you treat the value chain of firms. Do you also look at whether they are dependent from their other regions or things like that? And finally, one question on the first graph you showed about the evolution of GDP, whether it is a cumulative graph that you showed or just an average, a yearly average. So that's, maybe you can go back. That's one of the what was of the first.
Yes, so I hope I remember them all, but I will start, let's say, in order. So the first one was about the geolocation of the companies, if I got it correctly. And okay, so this is a very fair point, and it's also work in progress, let's say, to improve it. So we started from geolocating the headquarters of the companies. However, two things to consider. For the big companies, we looked at a threshold of, I don't know how much of total assets, I would need to check it, but basically we look at the big companies, and for those we rebuilt the subsidiary structure. So we could not look at the production facility of each of them, but we could actually look at all the subsidiaries and where they are located, and we geolocated the subsidiaries, at least to have a first order proxy of different sites in which those companies are located. For the other companies, you have actually to consider that 80% of these companies are SMEs, and SMEs could quite reasonably be proxied with the headquarters being located in the production facility. So we are aware there is a gap there to be filled if we want indeed to build the entire production sites of especially the large companies. However, this could not be done with the data sets we have available. So we looked for indeed a proxy that looked at the subsidiaries. The second point was about the chain, the value chain, and well, this is also another interesting question, but we didn't have the capacity to do so. So in order to do that, you would be able actually to understand which companies is depending on which, and to actually track all of these and see how one can affect the other. And this interconnectedness exercise was not implemented in this one, but we recognize the point, and I think could be a study by itself, to be fairly honest, because it's a quite massive tracking, especially when you're looking at more than 4 million companies. The way we looked at the production chain in a way is via scope 3 emissions. So this was our way to look at how, let's say, companies could be kind of affected in a broader sense. And the last one was about indeed the GDP, right? And this is a 5-year average GDP that is coming from the NGFS scenarios.
Maybe one last technical question before we go to a bit more deep one, regarding adaptation measures. Do you also include them in your transition costs, or is it not included? So it's about, you know, how the physical cost will hit us. Do you already take into account some adaptation measure in that?
So adaptation measures are partially accounted in the physical risk data we got from 427. So this physical risk indicator, as they say, also takes into account adaptation measures, but adaptation measures that are currently in place. They did not project future adaptation measures that could actually be implemented over the next years. They represent basically the picture as it is of now, and this is reflected into a lower magnitude of the impact of these natural disasters on the addresses that we have mapped.
Now, coming back to the question we had in the beginning, from hearing you, I would now choose, moderate, with some banks kind of very exposed to risk. But I think, I don't know if you share this assessment, but there is one question that is, I think it's your study has raised in the public about assessing and computing probability of default. So that's as you say, a big innovation in your study, and some people are questioning the fact that you can compute such probability of default, given that data are patchy, incomplete, and sometimes missing. Others are also saying that this is such estimation are not really robust. I mean, probably the standard error around them is probably large, which makes them difficult to use. And finally, just to list the comment that have been raised by some people, it's also that the numbers that you find are not really economically relevant. So how do you answer such concerns that some people have?
Yeah, no, that's also a very interesting point, and actually thanks for the question, because also gives the opportunity to clarify a little bit the philosophy, let's say, of this exercise. We definitely don't have the purpose, the objective, or the ambition to forecast the PDs for 30 years. I mean, whoever is pretending to do that would be, let's say, a bit, I mean, would be quite an extreme, let's say, exercise. So we are very much aware this is not what we want to do. We are not forecasters here, especially over such long time periods. However, here we had two objectives. First of all, to see how these PDs related to each other in different scenarios, in a sort of counterfactual analysis. What could happen in one scenario with respect to another, given the same assumptions, same conditions, okay, but just different possible future states of the world. And indeed, in relative terms, trying to see where the scenarios stand with respect to one another. And as I said from the very beginning, also from a public institution perspective. The second point was to see the trend. Where are we going? Like accounting also for all the standard errors that we are aware are in there, but indeed forgetting about the forecasting exercise, but more generally and more broadly, where the financial system or the non-financial corporate sector could go on average, slightly, approximately over the next 30 years, if we do this or not. So this was indeed the purpose here, to also give some indications to policymakers about what could be more appropriate, rather than indeed projecting or predicting the full probabilities. So I hope this answered the question or the concern.
Yeah. I don't know if everybody is convinced in the audience, but I mean, if they are not, they should raise their hand. Another question is about accounting for exposure and losses, not only to firm, but household and individual, both physically and also maybe to the transition. Do you plan to also look at not only the firm angle of the economy, but also household and regions?
No, that's also another interesting question, and for sure it would be an amazing step. The problem here with households is that we have no data. For privacy reasons, there are no information available on a household by household or loan by mortgage, let's say, level, even at the ECB or in any other central bank. And the problem with not having this granular information is that you lose all the heterogeneity of the physical risk impact that instead you could have with the non-financial corporates. So there are some, let's say, studies that are looking at these in aggregate, but once again, in aggregate, you lose the granularity and heterogeneity of impact. But I also know that now some banks or jurisdictions are starting requiring, for example, energy performance certificate information that could be added, let's say, to some data sets. So maybe some information will come over the next years, although in aggregate form, and we can see what we can do out of them. For now, it's not possible to extend this analysis to households. However, this will be done via bottom-up exercises. So the supervisory exercise, for example, of next year that will rely on a bottom-up approach will also collect some information on energy performance certificates and for the assessment on households. Also showing the complementarity between top-down and bottom-up approach.
Now, a question about how banks can also adapt their balance sheet during the transition or the crisis. So you have very long-term provision, and obviously banks will not keep their balance sheet as it is now. What are your assumptions in your model about such a possible reallocation that could decrease risks?
So once again, this was the first step. Next steps will come. In this first step, we relied on the static balance sheet assumption, assuming indeed that the bank's exposures will remain the same over the next 30 years. Now, we know that this assumption can be very highly criticized, is very simplistic, and so on and so forth. However, first of all, indeed, as a first exercise of this kind, we preferred, let's say, relaxing this part and focusing on, let's say, a more simplistic approach with the idea of increasing it or improving it for the next iterations. Secondly, this static balance sheet assumption allowed us to look at the impact that that could, like, let's say, at the projected impact of climate risks if it had to occur today. So imagine that physical risk materializes tomorrow rather than in 30 years. This is the impact that could actually affect banks according to their current exposures. The other thing is that indeed banks can adapt their exposures and shift, let's say, their portfolio allocation. However, this could also trigger second round effects on the real economy, because you cannot think that this is just a mitigating measure. Still, in a broader economic terms, will also have implications, typically as a credit crunch towards certain sectors that could trigger also second round effects that actually could also trigger, let's say, more complex feedback loops between the banking and the sector and the real economy. And this is actually what we are working on. So the next, let's say, iteration of the climate stress test will include a dynamic balance sheet, but not to be intended as a simple mitigating measures for banks, looking at how this could actually have an impact on the broader macroeconomy and how this could feed back into the banking sector again. It's coming next year.
Looking forward. One question that might be more tricky for you to answer, and you just tell me if you're not the best place for that, but it's raised by a central banker, so I guess it's interesting for everyone here. Even Fela is saying that you relies a lot on micro data from private entities like Urgent Term and 427 for this exercise. How is it? How do you think it is different from using, inflation forecast by Moody's or such things that are more established? Do you see a reputational or problem for the central bank, or how confident are you to use data from private entities for such an exercise?
No, thanks a lot for this question. And this is something that we also reflected upon, let's say, internally. We are in a situation in which there is shortage of data. So, and by the time we wait for regulatory data to be available, because collected and made available by the European Commission, well, at that point, it would be too late to actually have any assessment of transition risk, because if we wait 5 years before having any sort of quantitative assessment, well, then the orderly transition is already gone. It's not possible anymore. So we are at a juncture in which we have to start doing assessment and performing this analysis now. We have no luxury to delay them. And if we want to have some numbers now, we have to rely on the data sources that are available now. So we had to choose a very pragmatic approach here, and that's why we decided to rely on private data sources that actually were fit, let's say, for the purposes we had in mind, rather than waiting a few more years for public data, to be available. So this is the reason behind, let's say, going ahead now with private providers rather than waiting for regulatory information to be available. The second point is about the granularity. There are some public sources that are collecting this information, however, at a very aggregate level. And what we understood actually when looking at the data is that heterogeneity here when it comes to climate risk is everything. Because climate risk is not a matter of average that aggregate data could hide. It's a matter of outliers. And you can track these outliers or these tail risks only with granular information. This was one of the main takeaways, basically, of our analysis.
So you were basically following Frank Elderson when he says that it's better to use the data that we have now rather than wait for perfect data and probably make mistakes.
I very much agree with him.
that's brings me to my last question on my side. I think the impression we have from seeing ECB's results is that climate risk is a material risk for the financial system, and it's concentrated in some banks sometimes, and not always the best capitalized bank. So there is an issue of some institution and even the system being challenged and at stake. So the natural response for that is regulation. When you see risk arising, typically counter-cyclical buffer, when you see credit risk raising. So how do you think you are close to taking such decision, or what would you need at the ECB to recognize that it's a risk for the financial system and then take policy action for that? Do you need better data, or
Okay, so there are, let's say, two streams two pillars to answer this question. One is about the pillar. So it's related to supervisory action. So I mentioned already a few times, in 2022 there will be a supervisory climate exercise performed by our colleagues in banking supervision, and Mr. Anderson and SSM colleagues already clarified that the results of this exercise will indirectly affect the P2R, the Pillar 2 requirement. So there is already some action that is ongoing also in terms of capital requirements, but on the supervisory side. And this is also accompanied to a lot of supervisory powers and supervisory actions, as also proposed by the European Commission in their recent sustainable finance package. The other one that you're referring to, that is about the CCYB buffers or buffers in general, is more Pillar 1. It's more in the Pillar 1 sphere, whether this is micro or macro. Regarding these, the ECB is very much, let's say, discussing in the international debate how to move forward. So there are discussions that are ongoing in the Basel Committee, so in the BCBS Task Force on Climate Risk, that are evaluating how the framework actually could be impacted, and there are parallel discussions ongoing in Europe at the EBA level. But before, let's say, taking some measures, there are, let's say, a couple of steps that have to be performed before, and that we are currently doing. First of all is to assess whether the current prudential framework is already accounting for climate risks. Some jurisdictions even claim that the current framework accounts for this, because some buffers actually are designed to already account for climate risks. Some other jurisdictions do not very much agree, so you can understand that there is already a discussion here ongoing on whether there is any need to change the prudential framework. In case we assess that this need is material, then there will be another discussion on what aspects of the prudential framework should be changed and how to tackle these risks. So the third one then will be the impact assessment, whether, like, depending on which decision is taken, what this could imply for the capital requirements and the overall system. So it's a very complex discussion that is proceeding step by step. And we are just at the beginning.
Thank you very much for all this information, both technical and also a bit policy-wise at the end. And thank you for staying over time. Thank you also to all our viewers who have stayed until now. There are a lot of questions, some very technical. I suggest that those who want them answered, send them to the Slack channel, and we will do our best to forward them to you, Laura, so that maybe if you have time, you can answer them. That being said, it's our last seminar this year, so we're going to take a break for the holiday season. We will return with our next webinar on January 17. You will find up the date and the information about this seminar on our website, eaxis.org, and on Twitter and LinkedIn. And we will update the program for next year. As I said in the beginning, there's going to be a slight change of format that I hope you will like, where we're going to address one single issue over 3 seminars with different angle of view of it. Laura, thanks a lot for this presentation, and for all of us, have a nice end of evening or end of day. Thank you very much.
Thank you once again for the invite, and looking forward also to answering some further questions. Will be my pleasure.
Will do. Thank you.
Bye-bye.
Bye-bye.